Coming to our tax workshop, and thank you to our incredible team for running the tax workshop. I think personal and corporate income tax are some of the funnest parts of tax law because it's really sort of like where the rubber hits the road of progressivity. And turn it over to you guys.
Okay, thanks very much. So I'm Kirby Keaton. I handle the tax portfolio for the Office of Legislative Counsel.
And I am Pat Titterton. I'm with the Joint Fiscal Office, and I primarily work on our personal and corporate income stuff. So
we're gonna give you a reason to enjoy your break. Take that however you want.
I think we're going to get some late editions, some people getting lunch.
Okay, great. Okay, so yeah, we have a couple of presentations for you. We're going to go through the basics of the personal and corporate income tax and how these are put together for Vermont, and a little bit about the relationship between the Vermont version of these taxes and the counterparts at the federal level. And we'll start with the personal income tax. Talk about the structure, what's called an annual link up. And if that doesn't mean anything to you now, when you walk out of here, you will know what that means. And some definitions and some recent changes for the personal income tax. So first, in a nutshell, the structure of Vermont's personal income tax starts with what we call taxable income. That's the phrase that's used. And then we have a tax rates that are applied to an individual's taxable income. Vermont uses progressive brackets, and we also use marginal tax rates. We'll get into what that means later. And then the tax liability is part of the structure, because once you take your taxable income and you apply the brackets and the rates, there's still some further adjustments such as tax credits. And I guess when it comes to taxes, this is probably going to be one that most people are the most familiar with, right? Business and sales tax are the ones that we probably encounter most often. So let's start with the annual link up. So Vermont's laws in the income tax area borrow or piggyback off of the federal tax laws in a lot of ways. It used to be that Vermont really piggybacked off of federal, and there was a point in time where it was just a percentage of whatever you owed federally is what you owed to Vermont. We're far away from that at this point. Over time, we've moved away from reliance on federal law and have more of our own specific things. So at this point, we start with federal AGI. So the things that go into federal AGI are things that we rely on in our law. To do that, though, there's a couple of provisions in law that have to be changed every year to link us up with what is currently federal law, and we have to do that continuously. So that's what the link up is. It's something that is passed by the General Assembly every year and has to be done unless the legislature were to decide to freeze in place. So like, okay, we're not going to update annually anymore. We are going to use federal tax law as of 2024 forever, which is something that you could do. And that would start to become difficult. And it would make my life probably difficult because I would just have to know the law from 2024 and have to look that up all the time. But anyway, here's the link up language. I don't think we need to dwell on that a whole lot longer. And I can't tell you actually what bill we're going to have the link up language in at this point. I think things are moving around in the tax world, but it'll be in one of these bills that you pass. I'm looking at the chair of Ways and Means. I'm not sure if she knows, but maybe. Okay. Okay, so let's get into some of the definitions. The general starting place for the personal income tax is with gross income at the federal level. It means all income from whatever source derived. There are certain things that do not go into gross income at the federal level, and these are things that carry through to Vermont. So what is included in gross income, though, is wages, tips, salaries, commissions, rent, royalties, interest, dividends, IRA distributions, and on. What is not included is certain Social Security income, interest on state or local bonds, and cancellation of certain student loan debts. I have personal experience with that one because of public service loan forgiveness at the federal level. I had a lot of debt forgiven at one point, and I didn't have to put that on my taxes at all at the federal level. Didn't have to put on my taxes at all at the Vermont level because it's something that would flow through to Vermont. And you don't when it comes to things that are not part of gross income, that's not even something that you put down on your tax return. Then there's adjusted gross income. So you take the gross income and then you adjust it at the federal level. There some examples of common federal adjustments to gross income is teacher expenses, IRA deductions, student loan interest, tuition and fees. So those things get taken out of gross income before you get to AGI. And then that brings us to Vermont. We take the AGI, and federal taxable income is in Vermont is the adjusted gross income, or at the federal level, it's adjusted gross income minus itemized or standard or other miscellaneous deductions. But to put this simply, to understand this, any itemized deductions or anything that's happening after AGI at the federal level does not come to Vermont. Vermont's personal income tax defines taxable income as federal AGI without regard to certain things, and then we do our own additions and subtractions from there. And Vermont taxable income is different from federal taxable income, as I said. I think that's all I need to say about that. If people have questions about the difference between those things. Okay. Then we have a chart here about what those different pieces are. Again, gross income is where it starts. And then you take out the above the line deductions that we talked about to get to adjusted gross income. And then we take that adjusted gross income and we do our thing in Vermont from there. We have our subtractions from adjusted gross income. Those itemized deductions and the standard deductions at the federal level, as we said, do not flow through. Vermont has its own for those things. So for instance, if Congress were to make changes to the federal standard deduction, it's not something that in this building we have to worry about as far as responding to that through Vermont law. But the things that go into gross income and AGI, we would have to respond to if the General Assembly did not agree, for instance, and wanted to go a different direction. In Vermont right now, the standard deduction is $7,400 for single filers, $14,850 for married. We have personal exemption of $5,100. And we have our own state-specific subtractions, such as there's a capital gains exclusion where part of capital gains can be reduced. Interest income from U.S. bonds, we have a Social Security exemption and medical expenses exemptions or deduction subtractions. And that gets us to our Vermont taxable income. I mentioned that these things changed over time, that we've departed, moved farther away from relying solely on what's done at the federal level. So prior to 2002, Vermont's personal income tax was a percentage of federal taxable income. Then after that, the starting point for Vermont's personal income tax became federal taxable income instead. And then we moved off of that. And then by 2017, the starting point was moved to federal AGI instead. And then there's been further changes that were in response to the Tax Cuts and Jobs Act of 2017. some of those changes that were made in 2017. So this is some of the newer things that have happened in the personal income tax world in Vermont. There was the elimination of personal exemptions, the doubling of the standard deduction. Or actually, these things happen at the federal level. I'm sorry. At the federal level, there was an elimination of the personal exemptions, doubling of the standard deduction, and alteration of numerous itemized miscellaneous deductions. So a lot of changes with the Tax Cuts and Jobs Act, right? So Vermont's response, as I mentioned before, was decoupling from a lot of that, and Vermont having its own standard deductions and things like that. Vermont has also created Vermont Child Tax Credit and Vermont Social Security income exclusions in recent years. So as of 2022, we have a refundable $1,000 Vermont Child Tax Credit for children 5 and under. There's a proposal this session to increase that to children 6 and under. We have the Vermont Child and Dependent Care Credit was expanded to a refundable credit that is 72% of the federal version of that credit. Vermont's Earned Income Tax Credit was expanded to 38% of the federal Earned Income Tax Credit. And these types of credits tend to exist to provide some support to lower income taxpayers, the way. Like the Earned Income Tax Credit, that is. Vermont also has a student loan interest deduction now. The Social Security benefits exemption was expanded in 2022. And there's a new, as of 2022, there was a new $10,000 retirement income exemption. So there was a lot of changes a few sessions ago. And that's kind of the big overview of the personal income tax. Now we'll go into corporate income tax, which is so much more riveting. We have the structure and the definitions here. We have the recent changes, and we also have, I don't know if actually I may have cut the slides related to Tax Cuts and Jobs Act, but we'll see. We'll all be surprised when we get there. The tax base for the corporate income tax is called Vermont net income. The tax rates are based off of progressive brackets and marginal tax rates. And I'm now realizing we did not cover slides for those things. So I will stop and explain brackets and marginal tax rates. Do you have slides on it? All right. Pat wants that thunder. I'll leave that for him. So I'll just keep moving along then. For the corporate income tax, we have a minimum tax that's based off of Vermont gross receipts. And which of course means that if a corporation were to file with Vermont and go through the normal way of determining how much tax it's owed or is owed to Vermont, if that amount is very low, then the minimum tax would kick in and they would owe that instead. And then the way that we determine tax liability through something called allocation and apportionment. I'll walk through that. What that means is, you've got multi-state, multinational corporations. They make a bunch of money. Well, how does Vermont decide what portion of that is attributable to Vermont as opposed to other places, right? And we'll talk about how that's done. So who pays? When it comes to the Vermont corporate income tax, only U.S. resident C corporations. They're called C corporations as a piece of trivia because of subchapter C under federal law. The C does not actually mean corporations, just happens to coincidentally be subchapter C. Individuals and pass-through businesses do not pay corporate income tax. So if you're LLCs, partnerships, entities like that, taxes from that type of business income flows through to the personal income tax return. It's not corporate. So for your information, if there's discussion of changes to corporate taxes in this building, and sometimes it could be easy to think mom and pop stores or Vermont businesses. And actually, if you're talking about corporate income taxes, a lot of the times those businesses are not what you're talking about. They're not paying corporate income tax. It's mostly out-of-state corporations. So who pays? U.S. resident C corporations, incorporated entities. I'll just leave this info here if you want to know more about what a U.S. resident C corporation means. Who does not pay? We already talked about that. Pass-through businesses is the terminology used for partnerships, LLCs, sole proprietors. In some rare instances, an LLC could choose to be treated as a C corporation if it were to benefit them to do that. It would take a business being very large and having a lot of payroll and having a lot of insurance benefits that they pay, where it actually becomes beneficial for them to be treated as a C corporation. And in some instances, that's allowable. So Vermont net income. So the net income of a C corporation starts with federal taxable income. So again, we're starting off the place from the federal return. And then we have additions and subtractions of certain types of income. There's no deductions in Vermont allowed for what's called bonus depreciation, non-Vermont bond interest, or federal operating losses. There are deductions allowed for certain income that's added at the federal level related to foreign credits and job creating credits. And then we also have some provisions in our law for cannabis establishments to deduct business expenses because they're not allowed to do that at the federal level because of federal drug laws. And federal taxable income is the corporation's receipts. So getting into the math a little bit, minus allowable deductions. And we have a list of the things that are allowed to be deducted from that federal taxable income before tax is applied. It's a lot of math stuff that I'll leave to Pat. Here's an example of the tax rates we were talking about, or the tax brackets, that we were talking about. Again, Pat's going to cover this, I think, so I'll be brief about it. The basics that you could know is that Vermont's corporate tax is tiered, and that there's a top marginal rate. And when you hear about marginal rates, that means how much is being paid at the top bracket level, but that does not mean that that tax rate is applied to all of the income. It's, the first 10,000 is taxed a certain way, the next 15,000 is taxed a different way, with the rates typically increasing as you get through those tiers. This is just an example chart. This is not actually Vermont's. I don't think this is Vermont's current brackets. And we talked about the minimum tax earlier. The minimum tax applies to all active corporations, including LLCs electing to be taxed this way. The minimum tax is based on the amount of the corporation's Vermont gross receipts. That's pretty straightforward. If Vermont gross receipts exceed 300 million, at least $100,000 of tax has to be paid. If the corporation owed less than that using the traditional way of determining how much tax is owed. And now we get into allocation and apportionment. So multi-state corporations typically have complex structures. There's parent companies and there's subsidiary companies under that. They operate in different jurisdictions. So figuring out how to tax them can be complicated. So in a nutshell here, when a C Corp's income is derived entirely from Vermont, that's the easy case, right? All of the C Corp's Vermont net income is allocated to Vermont. So that's simple enough, right? That's not normally the case. Usually a C Corp's income is going to be derived from outside Vermont and within Vermont. And Vermont law apportions the corporation's income and then allocates it to the state based on the formula that we have. Each state has its own, or has historically had different ways of approaching how to do allocation and apportionment. So I'm gonna give you a little bit of background about that. And Vermont used to do it differently than it does now. There's three different ways to look at it. There's payroll, like how many employees do you have in that state? And then there's sales in the state, and then there's also property that's owned in the state. And any three of those could be a way to determine what kind of activity is taking place in that state. At this point, Vermont has moved to what's called single sales factor is the terminology used. And it's where we are only looking at sales into Vermont as the basis for allocating and apportioning income into Vermont. The policy difference is that you're looking at Vermont as a market to determine like how much are the residents of Vermont your market and contributing to your business, and not regarding where you're located, where you have property. The end result of that is that tax liability is going to be higher for out-of-state corporations that are selling into Vermont, and it's going to be less for and potentially a lot less for, say, a corporation that is based in Vermont, has a lot of property and payroll, but doesn't actually do a lot of business in Vermont. It sells out to other places. So they would owe Vermont a lot less using the sales factor approach that we use than if we used payroll or property. I guess that's it for me. Roughly.
So just while I pull this up, I'm going to basically do the same order that Kirby just did. We're gonna talk personal income first, and then we'll move to corporate income. I'm gonna touch on, some of the slides might look slightly familiar, but I want to run through something that Kirby just was talking about first, because I think it helps put a lot of the decisions that get made at the legislature in context with regards to sort of adjustments or financial assistance that's provided through the tax code. Yeah, just to start moving. So yeah, we'll start with the income tax calculation. So like Kirby was talking about, our very basic starting point, we're kind of linked up for the most part with the feds in this particular aspect. The first thing that shows up on your Vermont tax return is going to be your AGI, your adjusted gross income. That's where we start the whole process. And you know, that's wages, tips, salaries, self-employment income, you know, everything you'd think about as just being part of your you know, your personal income. So yeah, starting point, AGI. Vermont does do a couple of additions. We add back a couple of things that Kirby mentioned. But then this next point where we get to subtractions from adjusted gross income is really where the state starts making its own personal choices in how they want to apply the tax code to Vermonters. And so these subtractions right off the bat are going to be your exemptions and your deductions. I've got a couple of examples here. You know, we have our standard deduction. It's Vermont's own personal standard deduction. We've got our personal exemptions also defined in Vermont statute. But then there's other subtractions, and I have 4 things here, and I've got a longer list later on. But you know, this is where you can remove things like interest from those bonds. We have the Vermont state Social Security exemption, which if you fall under certain income thresholds, you get you know, what the feds allow you to deduct, and also what Vermont allows you to exempt. And so after you make all those sort of, I think Kirby referred to them as above the line deductions and exemptions, all those adjustments kind of get us into what your taxable income is. And so when you get to this part of it, your taxable income, that's the starting point for when you get to our tax brackets. And that's what flows through the tax bracket, which, as Kirby mentioned, are marginal. And I'll talk about, yes.
If I could just ask a question about the Social Security deductions on the previous page, because I've heard from people like why does Vermont stop taxing our social security? But is that saying that your social security income is exempt from taxation? Is that what that slide is saying?
In some cases, so basically.
Depending on your
Yeah,
adjusted gross income?
well, so that this is a little bit further up the food chain. Basically, because a lot of things flow through into the state, the feds have their own exemption that they allow for Social Security. I think at most you might be paying on 85% of your Social Security benefits. So by the time you get to Vermont and your AGI, at least 80 or 15% of that is already being sort of removed. Once we get, so that's sort of our starting point, right? That's back up at this top line here. Once we get to this third sort of section here where we see subtractions from adjusted gross income, we have that Vermont state Social Security exemption. And so what that says is currently, if you are a single person, we'll use that as the example. If you're a single person, and your AGI is below 50,000, you can exempt all of your Social Security from, so all of your Social Security gets exempt and is not included in this Vermont taxable income. There is a phase out range, so from $50,000 to $60,000 in income, that sort of phases out. So if you're at 55,000, you can exempt half of your Social Security income, and then above 60, you're paying full freight. So I guess it's true to say that Vermont does tax Social Security income, but it's also true to say that we, for a lot of people, exempt all of it and don't tax any of it.
Okay, so if you're making $50,000 a year or less and you're receiving social security, you don't get taxed on it in Vermont.
Correct.
If you get, okay, got it, thank you.
And there's a maximum amounts of Social Security benefits you can receive. And I think Pat would know better than me, but I believe they roughly line up. In other words, if all of your income is from Social Security, you're probably going to be able to fully exempt it. Is that fair?
Sounds right. Good question. So we got through, so the deductions and exemptions get us into where we can run that taxable income through the brackets. And there's a bracket for each type of filing status, which I'll show in just a sec. But once you've gone through these marginal tax brackets and applied those marginal rates to your taxable income, you're left with your initial Vermont tax liability. And this is before what we're going to talk about next, any credits that you might be eligible for. So I said I would talk about marginal brackets, and really, it's not too complicated. It's just using this single person as the example. Your income from 0 to 47,900 is going to be taxed at 3.35%. That next bracket from 47,900 to 116, just the income within that range is being taxed at 6.6%. So the income below that range is still being taxed at 3.35, but then just within that zone right there, it's at 6.6. So for example, if you're someone who's earning 500,000, you're passing through every single one of these brackets, and the rates within those ranges apply only to the portion of your income that's within that range. So, like I said, if you're really high income, you're passing through every single one of our brackets. So actually, if you make changes to rates on the lower brackets, you're actually affecting a much broader base, because everyone has to pass through that bracket, right? It's not till you get into some of the much higher brackets where, I think above 500,000, we're talking about maybe 3,500 resident tax returns. So once you get to those really high incomes, you're talking about a much lower percentage of returns. Whereas at the lower bracket, it's everybody. Yes.
So when we see Vermont in a national context and we're compared to other states, if those other states don't do it this way, are we kind of misrepresented somehow? Or
So I wish I had the slide that I think would address that next. Because when you just look at the tax brackets, it can look relatively, I mean, the thing we're going to talk about next, the credits and, you know, in addition to the exemptions and the deductions, really do feed into sort of the progressivity of the tax schedule in Vermont. I mean, we do have a progressive tax rate structure here, but also we make further adjustments with those credits and exemptions. So I think the ITEP report had us at like the 49th most progressive or 49th least regressive. This is not, like I said, 49th least regressive tax system. It's a funny terminology. I guess I'd just say second most progressive.
So good.
Good, yeah. And so, you know, a lot of that is not just because of the brackets we have here. I mean, they are progressive brackets, but at the same time, but the reason I wanted to sort of talk about the credits up next with running through this again is, you know, there are a lot of like sort of intentional decisions that the legislature has made to prioritize giving people financial assistance through the tax code and adjusting for sort of specific, you know, life situations that particular taxpayers are in. So yeah, so after we get through the brackets, we get to sort of the next like fun part, where first the state first removes your non-refundable credit amounts. And I have definitions for these on the next slide. After we get through non-refundable credits, we then subtract out the refundable credits. And then we just make sure that we're only taxing people on income that should be apportioned to the state. So it's just basically the ratio of how much of your income is basically Vermont income. And so that's just the full flow chart. And once we get to the end of that, that's really where you see what your final Vermont tax liability or refund is. So I wanted to go through all that and give you just a quick definition of what I mean when I'm talking about exemptions, deductions, and credits. So exemptions and deductions, those sort of above the line adjustments that we make, those reduce the taxpayer's income that is subject to tax. So it's sort of an indirect way of lowering tax liability. This is before you get to the income tax brackets. Yeah, so generally they just reduce the amount of tax the individual has to pay on. It's the sort of the base amount. Credits, on the other hand, these are dollar for dollar amounts that taxpayers can claim on their return to reduce their income liability. That was that sort of last line that we saw there. And there's two types. First, we've got a refundable, which really just means, I'll use an example to describe it. If you've got a tax liability of $100, but you're also eligible for a $200 credit, you wipe out your tax liability and the state owes you a $100 credit, which is the difference between the two. Non-refundable, if you're in the same situation, you've got $100 liability and a $200 non-refundable credit, you wipe out your tax liability, but you don't get any money back from the state. So just to come back here real quick, the reason the state gets through the subtracts the non-refundable credits first is because if we can get your liability down to zero, just doing that, then you can receive the full amount of your refundable credits in the form of a return. So this is not an exhaustive list right here, but this is, I believe, everything that we include in the tax expenditure report, meaning that they all should have statutory intents. And I have a slide a little later on showing you sort of what this means in terms of foregone revenue to the state. But there's two at the bottom here, the child tax credit and the earned income tax credit. Those are two of the biggest, maybe they might be actually the biggest two. No, sorry. They're two of the biggest tax expenditures to the state, but the two biggest in the world of private or personal income taxes. So those are the two primary credits that are sending money into Vermonters' pockets based on, you know, certain lifestyles or behaviors the state wants to support or give assistance to.
There's been a lot of talk about whether we should exempt military pensions from the tax base. I see military pay up there.
Mhm.
So we currently don't tax military pay?
Military pay is different than the pension debt.
Yes.
So if you're active duty and you're receiving income from the military, there's an existing exemption allowed for that. Military retirement benefits is a different type. So that's basically your pension pay after you've retired. So it's a good question. Those are two different. I mean, someone could actually collect military pay for a while and then leave service and not actually qualify as a retiree eligible for benefits because you have to hit certain service milestones to be eligible. It's kind of like vesting in a way. So those are two different
Thank you.
things. Okay, so that's sort of a run through of how we do it and what we do. This next section will sort of look at how that manifests and sort of the overall context of state revenue and the income you're expected to pay based on, or the taxes you have to pay based on your income and what you qualify for. Yes.
I just had a question about the former slide. What is the facade improvement exemption?
So there's three on here, the historical rehabilitation, facade improvement and code improvement credits. Those are all within the downtown and village center program. So basically what the state does is they will give a credit to a developer for an approved project defined by one of these three. And the developer has a couple of options. They can either take that credit and claim it against their own liability, which a lot of them will be for in the personal income tax world, they'll be basically operating a pass-through entity. It's like an LLC or sole proprietorship that that income ends up on your personal income tax returns. So they have the option to claim the credit on that form. What they do often do is actually sell those credits for maybe 95 cents on the dollar to a bank or an insurance company, and then they can claim that credit sort of outside the personal income tax world on their tax liabilities. But they kind of all live under that umbrella of the program. To speed up. So I just want to show you this to show you sort of the importance of personal income taxes in the context of state revenue. Going back to about 2005, the personal income taxes made up 48% of total general fund revenue. Looking to today, we're up over half of general fund revenue is coming from this tax type. It's one of our biggest. I think up until maybe a year or two ago, it actually was pretty consistently bringing in more money to the state than property taxes. But they're very close to each other now. But so it's one of the biggest revenue streams for the state overall, and it's really important to sort of general obligations the state has through the general fund. And that seems to have just been increasing over time, the importance of that tax type to general fund revenue. What I want to show you here is just how tax liability sort of changes as your income changes. So at the low end of the income range here, you see, below $25,000, on average, those people are actually getting more money back from the state than they're paying to the state on aggregate. And that's 90,000 returns, which is it's like maybe 30%, or it's right here. It's 27% of total taxpayers in the state are actually on average getting money back from the state via those refundable credits. And then you can see once you get up above 300,000, it's about a little over 9,000 returns in the state, 3% overall, but they're contributing about 42% of overall state personal income tax collections. And this is just showing you resident returns. I also have a little note here that there's, about 54,000 returns in 2022 that contributed another about $100 million personal income tax receipts. This is kind of looking at the same thing as the table before in a little bit different way. In the blue bars, this is just showing you how many tax returns are in those buckets. And then the orange line here, excuse me, shows you the amount of taxes that those returns are accounting for. So you can see all the way at the bottom here, it's below zero, kind of illustrating what we just saw, that they're actually getting more money back from the state. And I think this is starting to get a little bit at your question before about how it fits within the context, Vermont's tax brackets. You can see here that, if you were just to look at the tax brackets, everyone should have a positive tax liability. But so what's here are the effective tax rates, which just if you take your total liability and divide it by your total income, it's sort of like your average overall tax rate, rather than looking at the marginal stepped way. And here, it's really not until, again, 25,000 that you get to a positive effective tax rate. And even for a lot of these folks, between 25,000 and 50,000, while it's sort of a positive effective tax rate, it's still quite low. I mean, the statewide average is 3.8%. And it's not until you get to really high incomes that you actually get anywhere above the average. It's 150 plus before you get to the above average range. This, I just want to sort of show you some of the top marginal rates and some of our neighbors. I also want to show you on this far right column just how the different brackets are structured. And I think that really just highlights the fact that just looking at tax brackets doesn't tell the full story, right? And, just to reiterate that point, if we're just talking about tax brackets, this is how we sort of look compared to our neighbors. Vermont is in green. And you can see that at the low end of the spectrum, we're actually below most of our neighbors. Connecticut's that little light blue line. That's the only one that's slightly below. But their lowest rate only applies to a much lower range of income. So it's hard to compare them apples to apples in sort of any situation. And they all have different credits and exemptions too. And this is from the most recent report, just showing you that about $100 million we've got about $100 million that we provide to people in the form of exemptions, deductions, and credits. And so this is all foregone revenue by either giving the credits or exempting the income. It's income or revenue that the state is opting to not collect to pay for, appropriations. So I guess we'll do a kind of a speed round for corporate income tax. There's sort of one big takeaway. I know Kirby said he doesn't like talking about it before, but I find corporate income actually more interesting. And hopefully, it is in some ways a very complicated subject, but I think that there's some very simple basics that you can latch onto to sort of understand, for the most part, how it works. So Kirby talked about some of this. There's corporations and pass-through businesses. We're really, when we talk about corporate income, we're just talking about corporations. It's not those self-employed individuals or people who own a business necessarily. It's just corporations or C corps that we're talking about. Kirby covered all of this information. What I think if you're to take away one thing here, and Kirby talked about this a little bit, but if you can take away this little equation we have here at the bottom. So, right, we use the same definition of federal taxable income when it comes to corporations. That's that starting point right here. But when we start to talk about how do we account for what a sort of national or multinational corporation should be paying to Vermont in taxes, we have what's called the single sales factor. And so one important thing about the single sales factor is that it's fairly agnostic about where you're located. We don't care if you're located in Vermont. We don't care if you're located in Delaware or anywhere else. If you are selling into the state and basically accessing our market, the state has said, well, then you owe us on your, basically your access to our market and our consumers, right? So it's a simple calculation if you just take their total US sales and compare that to their just Vermont sales. So it's just a ratio right there. So you take Vermont sales, let's say it's 100, and you divide it by total sales. Let's say that's 500. 20% of your total federal net income is apportioned to our state. So I think that that's, if you can sort of take that away, it's really sort of the most important thing when thinking about how does Vermont treat national and multinational corporations, and how do adjustments to corporate income tax in the state affect sort of local businesses, right? And then, yeah, so that runs through as the tax rate structure that Kirby showed you. It's here. Kirby did actually, I believe, have the correct current tax brackets in his slides. So again, this is marginal. It's set at fairly low levels. So, you know, you only have to have $25,000 or up of net income apportionable to the state to hit that top marginal bracket. And then, yes, here's the minimum tax schedule. Basically, we did explain that. So I want to look at it by the numbers. In the January 25 consensus forecast, Tom and Jeff are forecasting about $260 million in revenue from this source. Which, if you compare that to last year, it's about a $20 million upgrade over last year, or 8.6% increase. And corporate income revenue, it's not as big as personal income taxes. So I think that showed about 54% of total general fund revenue. Corporate income is about 11%. So, but if you put them together, these two tax types are funding about 2/3 of general fund obligations, or, you know, the revenue from it anyway. Yep, and this is just showing you how over time that's changed. You know, I think right about this inflection point here is when there was sort of a modernization of the corporate tax code in Vermont. I'm not going to go through, I've got some slides at the end that you can all have for reference on what those changes were and how they impacted things. But, you know, that spike there is also kind of coinciding with the COVID era, where we actually did see a rather dramatic increase in corporate profitability. So it's kind of coincidental that it's right when our new tax code kicked in, but also it sort of coincides with a pretty dramatic increase in corporate profitability overall. And on this slide, I just want to show you it's a fairly volatile tax type. This is just showing you the percent change year over year in tax collections from corporations. So you can see that some years we see these big spikes, big increases from the year prior, and this is in percent terms. Big spikes, increases from the year prior in collections, but then immediately followed by a reduction from the year prior. And that's normal for this tax type. I mean, the long range trend would show it sort of increasing over time, but just looking at it from a year to year basis for budgeting, it does bounce around quite a bit. So it's good that it's in the sort of larger pool of money that funds the general fund, because if corporations are not contributing a lot to that fund, we do have these other legs of the stool in the fund that can keep it relatively stable in time. I'm out of time, but I think that there's some good references in here. I think I've covered the most important things on corporate income taxes that I wanted to. And again, there's some more detail a little further on about what that modernization of the corporate income tax code looked like in 2022. I'm sorry, I didn't really have any time for questions, but I'm still here. So if anyone wants to ask one, I'm happy to answer.
Thank you.
Thank you.
I have a question. So you mentioned that single sale factor, it's agnostic about location. I'm just curious if any states, especially I'm thinking of like monopolies like Amazon, do any states use that factor to maybe charge more to a certain type of corporation? Not being agnostic about business type, or, you know what I mean, where there's actual implications for your small businesses and, you know, there are societal costs from that type of corporation, like, do we ever see?
Yeah, I don't know if this is exactly what you're getting at, but I would just say that like the way that Vermont is set it up is to be favorable in the instances you're talking about to tax out of state corporations more than in-state ones.
But-
Like,
but-
because you're looking at just the sales.
Because, yeah, I guess Kirby touched on this a little bit previously. We had payroll and property as part
Right.
of the equation. So if you were a business with a heavy Vermont physical presence, that would have been a less
Oh, I
advantageous
see.
system.
So that's what you mean by
Only-
agnostic.
Yeah, so we don't care where they're located. It's basically just the entry fee kind of for accessing our market.
I was thinking more about their behavior in the world
Yeah.
and being agnostic to that.
No, no.
Or not.
No, it's agnostic about where they're located.
Yeah.
It's entirely possible for a corporation to be based in Vermont and not owe Vermont corporate income tax.
Because there's no sales.
Is it? Yeah, they're just selling up, making sales other places.
We wouldn't need any other taxes.
There's no way to do it. It's code, I guess.
You can increase the corporate tax rate to have those companies pay more.
That are like that type of retailer, like it would be discriminatory because it would have like. It would be a
Discrimination of certain companies is where I look to Kirby.
I'm not sure what details you're plotting here, so I
I
don't,
think
it's hard to
the
tell.
question is, would you target particular industries with different formulas? Is that
Yeah, that's basically what I'm saying, like Amazon.
There's there's ways to do that legally and there's ways to do that illegally, I think, like, like, you know, we have things like excise taxes on specific types of things and
That's a more
and
appropriate.
that can be allowable. It's just, I would just need to know to be able to analyze all the details with that to see if it's discriminatory. In general, if you're worrying about like the Commerce Clause and what amounts to discrimination, it's like putting an undue burden on interstate commerce through discriminating against out-of-state versus in-state. But something like our corporate income tax, it doesn't do that because we're treating all corporations the same, no matter where they're located.
Right,
And so there's not discrimination.
for that.
But if we literally said you pay twice as much corporate income tax if you're not located in Vermont, that's not constitutional. But in the tax world, things that are kind of like a violation of the Commerce Clause are allowable because the reasoning for it is not to discriminate. You can have some indirect discrimination that you can kind of get away with. I mean, the fact that, you know, we have a homestead declaration and in theory, the way our system works now, it's gotten out of hand a little bit, but the thought was like if you have a homestead, you can get a property tax credit. And so that's favoring residents because if you're a non-resident, you can't get that, right? But the reasoning for that though, is like the policy reasoning behind that is not to discriminate. It's other things. And so that's generally not something that would be illegal or challenged in favor.
Very interesting, thank you.
Thank you.
all for coming.